Good morning, everyone, and welcome to our first series of our 2017 monthly webinar series, Keys to a Successful Audit. Our presenters are going to be Terry McKnight and Trevor Williams, who is stepping in for Amy Boland, who unfortunately could not be with us today in today's webinar. Terry has worked in accounting and auditing services since 1989. Her responsibilities include managing all phases of nonprofit audit and consulting engagements in accordance with generally accepted auditing standards and government auditing standards. She is also the director of the audit department and as such leads our audit practice at Gelman, Rosenberger, Friedman. Trevor Williams is one of our non-audit partners. Trevor Williams has worked with audit functions, contractual compliance rules, regulations, policies, procedures, and accounting operations since 1996. He manages the overall planning and administration of audit, review, and compilation engagements. Some housekeeping items for today's webinar. If you have any issues, any technical difficulties, please contact WebEx at the number listed on the screen with the event number and the event password as listed. Today's webinar will be recorded, and the recording will be made available after the event is finished within the next couple of days. Also, please feel free to use the chat function during the webinar for any technical questions that may arise during the webinar. The CPE credit information. Attendees seeking the CPE in this presentation must complete a short evaluation survey at the end, and some pop-up questions will come up during the webinar. 3 words will be shared during the webinar, and the survey will ask you for those words. So please make note of those words so you can gain the 1-hour CPE, which is being offered today. If you do not have those words, you will not be able to obtain the CPE. Again, if you have any technical questions, those can be addressed to Alina Stone at astone@grfcpa.com or at the number 301-664-9357. Also, please make sure to turn off your pop-up blocker. Again, this presentation will be available to download at our website, grfcpa.com/media/131.pdf. The objective of today's webinar is to provide attendees with a better understanding of how to have successful audit. Again, this is done via group internet. Everybody will be able to obtain 1-hour CPE in the area of accounting and audit, and there is no prerequisites required. And this slide also talks about the refund policy, which obviously there is nothing, and cancellation and complaint resolution policy, since we always are committed to a seminar in which the participants are 100% satisfied. So if any issues come up or you're not fully satisfied with the webinar or you have any complaints, please let us know as soon as possible by emailing kdavis@grfcpa.com with any concerns. Today's webinar we're going to talk about 10 keys for successful audits, 10 key points that everybody should keep in mind for successful audits, and these are listed on the screen. And finally, we're going to close with a quick FASB update, which our presenters are going to discuss in more detail. So with that, I'm going to turn it over with Trevor Williams, who's going to start talking about one of our key items. Trevor?
All right. Thank you, Ricardo. Good morning, everyone. Again, my name is Trevor Williams, and our first key for the day, actually, excuse me, before we start, I'd like to give the first key word in order for you all to receive your CPE credit, and that first word is audit. All right, without further ado, if you see on the first slide there, why have a financial statement audit? Independent, unbiased verification. As you know, an audit provides the highest level of assurance and as such requires more work than what is required for either a compilation or review. The most significant difference between an audit engagement and other financial statements is that the auditor is required to corroborate the amounts and disclosures included in the financial statements through tests of accounting documents, physical inspection, and the use of third-party confirmations or other procedures as deemed appropriate. The objective assessment of risk, controls, and compliance. These are also issues that your auditor takes into consideration during the planning phases of the engagement. Financial transparency. This particular bullet is more important than ever. The information is made accessible as possible, and the timely, meaningful, and reliable disclosures about a company's performance. It's also important that you are not actively hiding things, being honest about your performance even when it is subpar. These 4 issues are very important with regards to the financial transparency of your financial statements. What is fraud deterrence? Usually when people hear the word audit, they tend to get sweaty palms and their heart rate goes up, fearing the big boogie audit men are on their way. In reality, the financial statement audit helps management and those charged with governance because the independent auditors have auditing standards that they follow to identify material misstatements due to fraud. Additionally, your accountant will inquire and request representations from management if there are any allegations or suspicions of fraud or illegal acts within the company. Compliance with laws and regulations. Depending upon what field your organization is operating under, you may be required to have an audit in accordance with generally accepted accounting principles. And also you may receive funding that would require you to also have a financial statement audit. Knowledge to enhance internal controls, efficiencies, and effectiveness. These are also reasons why to have a financial statement audit. The second slide, understanding the type of audit. Financial audits performed in accordance with generally accepted auditing standards in the United States of America, government auditing standards, single audit under Title II CFR 200, Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards, a program-specific audit, and international standards. The first bullet point, generally accepted auditing standards in the United States of America, or what we refer to as U.S. GAAP. The accounting profession relies on generally accepted accounting principles to regulate the standards of accounting in the United States. Us as accountants adhere to GAAP for consistency, fairness, honesty, and accuracy in measuring and disclosing financial information. A company's fiscal reports have significant impact on the decisions made by the investors, employees, and financial institutions, and GAAP provides a set of foundational guidelines used to support this analysis. The idea behind GAAP is to keep requirements equal for all businesses and adopt some uniformity in the field of accounting. Government auditing standards, also known as the Yellow Book, provide a framework for conducting high-quality audits with competence, integrity, objectivity, and independence. The Yellow Book is used for audits of governmental entities that receive governmental awards and other organizations performing Yellow Book audits. The single audit under Title II CFR 200 Uniform Administrative Requirements. Federal agencies that provide federal assistance to state and local governments and also nonprofit organizations rely on the single audit as part of their overall oversight responsibilities. Performing high-quality single audits is a must. The Office of Management and Budget issued these guidelines, which are also referred to as uniform guidance, has changed auditor requirements generally for those organizations with fiscal years ending after December 31st, 2015. A program-specific audit is an audit of an individual federal program rather than of an entity's financial statements. And generally, this type of results in a single statement of expenditures and change in fund balance of the federal program activities administered by the recipient, including notes to the financial statements. This type of audit is conducted in accordance with government auditing standards. In addition to the reports of the financial statements, there may be 2 additional reports that could be issued, one on internal control over federal program and the other on the entity's compliance with those federal program requirements. International standards. International standards on auditing, or ISA, are professional standards used for the performance of financial statements and financial information. And these standards are issued by the International Federation of Accountants. Who are the readers? Typical readers of the financial statements include board of directors, donors, regulatory agencies, charity watchdogs, and banks. Board of directors read the financial statements for a number of reasons, but most importantly, they use the financial statements or audited financial statements in order to make wise and prudent decisions as it relates to the organization. Donors, as well as charity watchdogs, look at the scope of the engagement, naturally the auditor's independent opinion, program breakout, as well as the total expenses as it relates to total programmatic expenses versus G&A expenses. For the most part, the charity watchdogs want to make sure that the organization are using as much of the contributions received for programmatic activities. Banks take a look at your independent auditor report, especially if the organization owes some type of debt or line of credit to the particular bank. They take a look at the amounts as well as compliance in order to arrive whether or not the organization is in compliance with various covenants as it relates to those loan agreements. Point number 4, understand auditee versus auditor responsibilities. The auditee responsibilities: the preparation and fair presentation of financial statements, selection and application of accounting principles generally accepted in the United States of America, establishing and maintaining internal controls to mitigate material misstatement, identifying a person with SKI, which is the abbreviation for skill, knowledge, and experience, and accepting responsibility on those financial statements. With regards to preparation and fair presentation of financial statements, internal controls help ensure that the departments within your organization, other than the accounting and finance department, are performing as expected. When the subject of internal control is discussed, the conversation frequently centers on control activities or procedures rather than the bigger picture of the whole internal control framework. To execute its responsibilities effectively, management needs to understand how integral internal control should work. At the conclusion of my particular portion of this webinar, Terry McKnight will discuss in more detail the internal control framework. As we all know, even though internal controls are well designed and effective, some controls may be overridden by management itself. Management's position in the organizational hierarchy creates an opportunity to manipulate or override otherwise effective or properly designed controls. Hiring and promoting managers with good character and high ethical values can go a long way in building a positive control environment and diminishing the risk of management override of controls. In my opinion, I believe the bottom line is that the responsibility for establishing and maintaining sound internal controls commands the attention throughout the year, not just when the auditors arrive. Management should remain alert for new and changing risk at all times and be flexible to modify and/or change controls as soon as new risks have been identified. I like to touch on that last bullet point, identifying a person with SKI and accepting responsibility. As I mentioned, SKI is an acronym for skill, knowledge, and/or experience. It's usually someone within the management of the organization, but what exactly are they responsible for? That designated person is responsible for the financial statements, including the notes to the financial statements, that they have an understanding of those financial statements as well as the notes, and are in agreement with those results. That individual also understands that the auditor has prepared the financial statements based on the information provided and the information that is provided to them. That person also understands and approves any audit adjusting entries and/or path adjusting entries proposed by us. And that person also has the ability to inquire or ask any questions or provide any edits or changes to the draft financial statements prior to them going final. And they are also responsible to ensure that corrective action has been taken regarding any management letter comments. Auditor responsibilities. Opine on whether the financial statements as they are presented in all material respects in conformity with U.S. generally accepted accounting principles. Plan and perform the audit to obtain reasonable but not absolute assurance. Consideration of internal controls. Evaluate accounting policies and significant estimates, as well as issue a management letter identifying deficiencies in internal controls. I'd like to touch on that second bullet point, primarily plan and perform the audit to obtain reasonable but not absolute assurance. It's important to note that absolute assurance means that there is absolutely no misstatement in the financial statements, and the financial statements are absolutely reliable. Reasonable assurance, on the other hand, is also a high level of assurance, but it means that the auditor has conducted the engagement in a way that he or she is reasonably sure that the financial statements are free from material misstatement. However, there may be some misstatements that go undetected. Such limitations that restrict the auditor to gain absolute assurance are known as inherent limitations of an audit. Consideration of internal controls. The independent auditor is required to consider your internal control over financial reporting as a basis for designing audit procedures for the purpose of expressing an opinion on the financial statements, but not for the purpose of expressing opinion on the effectiveness of your internal control. Accordingly, the independent auditor does not express an opinion on the effectiveness of your internal control. I think that's a key point, definitely stress regarding the consideration of internal control. The auditor is not there to express an opinion on the effectiveness of the internal control. Evaluating accounting policies and significant estimates. As we know, accounting estimates are a key part of the financial statements, and that they are prepared by management, and they are based on management's knowledge and experience about past and current events. The auditor is required to evaluate the key factors and assumptions used to develop these estimates and determining that they are reasonable in relation to the financial statements taken as a whole. Most common estimates that you see are depreciation, the collectability of receivables, and the allocation of expenses to programs. Issue a management letter identifying deficiencies in internal controls. This particular deliverable that you should receive from your auditor is one of 3 deliverables, this management letter, and it identifies 3 key issues: material weaknesses, significant deficiencies, and best practice recommendations. I think it's important to note at this time that the auditor's consideration of internal control is not designed to identify all deficiencies in internal control. and therefore there can be no assurance that all such deficiencies have been identified. Again, you'll see that we again have this concept of reasonable assurance. Additionally, there should be no surprises in this letter. Management should have the opportunity to see this letter and discuss its comments prior to it making it to print. One of the key factors for that and key benefits in having these discussions before this particular document becomes final is that it ensures its accuracy, as well as determining whether or not there's some additional information that the auditor may be unaware of at the time of issuing the comment, and or there may be mitigating controls that the auditor should be aware of. In my opinion, I believe this particular document, this management letter, has enormous value in the overall audit process. As we all know, a great majority of independent auditors are able to perform an audit satisfactorily and issue the report. A great majority of independent auditors are able to perform the audit satisfactorily and identify material weaknesses and significant deficiencies and provide recommendations. However, very few auditors are able to provide best practice recommendations that allow your organization to become more efficient, more effective, and be competitive and or current with similar like organizations. Understanding the audit approach, audit planning. This particular bullet point or slide is very important for those of you in management so that you get an understanding of exactly what the audit process entails, not just actual field work at your respective locations. The auditors spend a great amount of time prior to the start of actual field work regarding audit planning. As part of the audit planning process, the scope, the timing, and the resources needed to complete the audit are determined in-house. There are preliminary discussions of the control environment, which includes conversations with those charged with governance, taking a look at the operations of the organization, taking a look at the industry and other external factors in which the organization operates, measurement and review of financial performance, taking a look at the preliminary or unaudited financial statements, and a review of the accounting systems and internal controls. Additionally, during the planning phase of the engagement, the auditor takes a look at various risk assessments, taking a look at inherent risk, control risk, as well as detection risk. Additionally, during the audit planning process, the auditor takes a look at various complexities of the significant estimates. Again, as I mentioned earlier, typically the organization will have various estimates included in those financial statements. And depending upon their complexity, prior to the actual start of field work, these things get looked at in the planning phase, and an overall audit approach is then determined in order to gain an understanding of these complex estimates and see that they are reasonable in relation to the financial statements themselves. The auditor also takes a look at fraud risks. Key fraud risks are management override of internal controls, as I had mentioned earlier, improper revenue recognition, improper financial reporting, fraudulent cash disbursements and misappropriation of cash receipts, fraud associated with federal funds. Additionally, other risks include implementation of uniform guidance and compliance with applicable federal requirements, as well as following up on federal findings reported in the prior year, compliance with laws and regulations, allocation of costs amongst entities, and account reconciliations, which include prior year significant deficiencies. Again, all of these things get analyzed and talked about between the audit team prior to the start of actual field work. With that being said, I'd like to turn it over now to Terry McKnight.
Thank you, Trevor. Good morning, everyone. It's a pleasure to be on this webinar for you today. Before I get started, I would like to give you the second word for CPE credit, and the second word is success. Again, the word is success. So here, the sixth key to a successful audit is really understanding those key internal controls that Trevor's been talking about that really mitigate the risk within your financial statements, and be able to discuss those key controls with your auditor. As Trevor mentioned, management is responsible for establishing and maintaining these internal controls. We do realize this can certainly be challenging in today's environment, especially since there is a significant use and dependence on technology. There's increasing regulatory requirements, scrutiny by those charity watchdogs that Trevor mentioned, globalization, as well as many other challenges. So some of those key processes that the auditors or that we want to know about are surrounding those cash disbursement cycles, the cash receipts, revenue recognition, payroll processing. We will also look at those controls for significant areas or account balances such as investments, notes payable, fixed assets, the IT environment. The list can go on depending on the operations in place. So as a means to satisfy management's responsibilities regarding internal controls, we do recommend that you look at the COSO's Internal Control Integrated Framework. And COSO is the abbreviation for the Committee of Sponsoring Organizations of the Treadway Commission. And by using this framework, you can design and develop an effective and efficient system which will help an organization adapt to the changing operating environments. It will help mitigate risk to an acceptable level, and it will also help support sound decision-making by the governance of the organization. As you can see, the COSO framework is comprised of 5 components. They are control environment, risk assessment, control activities, information and communication, and monitoring. The control environment is a set of standards and processes that provide the basis for carrying out the internal controls across the entire organization. It is truly the tone at the top from the board and senior management that expresses the integrity and ethical values of the organization and the importance of following all the controls that are in place. The risk assessment is identifying and assessing risk in order to achieve the objectives. In order to assess the risk, you have to set those objectives that relate to operations, reporting, and compliance. The control activities are the actions established through policies and procedures that help ensure management's objectives are actually carried out. The control activities can be performed at all levels, and they may be preventive in nature or detective in nature, and may involve manual or automated activities. Information is necessary to carry out the internal control responsibilities. Management obtains or generates and uses that relevant and quality information from both internal and external sources to support the functioning of the internal controls. And the communication is the process of providing or sharing, obtaining the necessary information within and throughout the organization, as well as disseminating that information. And last but not least, that monitoring, those are ongoing evaluations, separate evaluations, or some combination of the two that allows or to ascertain whether each of those 5 components of internal controls is present and functioning. So these 5 components, along with the 17 principles, will help define and shape those controls to reach those objectives. And it certainly will help management have those discussions with the auditors so they can test those key controls. So this next slide, we work with many organizations here at Gelman, Rosenberg, and Friedman, and those organizations do receive federal funding that must comply with Title II CFR 200, the Uniform administrative requirements, cost principles, and audit requirements for federal awards, also referred to as just uniform guidance. So we wanted to specifically address those awards. So our seventh key to a successful audit is really understanding the compliance requirements associated with those federal awards and be able to provide the required documentation to support compliance. So first, review the award document and summarize the compliance requirements that are applicable to the particular award that you did receive. And this compliance summarization really should be given to finance staff, grant staff, program staff. Everybody who is involved in the work of that grant award should be made aware of these compliance requirements. Then you need to identify which cost principles and administrative requirements to use. And as we all know, OMB Circular A133 is completely obsolete. The audit requirements are all under uniform guidance. However, cost principles and administrative requirements can be applicable if the award that is being worked on during the particular year under audit was issued prior to December 26, 14, and if so, you should be using the circulars for the cost principles and administrative requirements. So those are the old circulars, A122, A110. Any funding increments received on those old awards, it's going to depend on what the funding document says. Some of the award agencies have been great about identifying if they want you to use the old circulars or if they want you to use the new uniform guidance, and some are not. So if it's not specifically identified on your grant document or your funding increment document, please go back to your federal agency and get in writing what circular or UG they want you to use. And any new award that's been issued after December 26, 14 is definitely under the uniform guidance, cost principles, and administrative requirements. So once you've determined the compliance requirements that you must follow and determine what cost principles and administrative requirements, you want to make sure that your internal controls are up to date, especially with those in compliance with the uniform guidance, because there were new specific requirements that were given throughout that document. Another area to look at is the contract and subrecipient relationships to ensure they have been properly identified. Just because the document may have the word contract at the very top of the first page, it may or may not be a contract. You have to look at the substance of the document for clarification. So if it's a contract, the purpose within the document is going to be to obtain goods or services, and you would follow all the procurement rules associated with procuring for a contract. If the substance of the agreement is to provide uses of the federal funds to carry out a program activity, that's going to be a subrecipient relationship, and under those you need to look at the management and monitoring standards under subrecipient. So again, be very careful in looking at the documents to clearly identify between the two. Compliance with procurement and suspension and debarment. As we all know, for those who are working with federal funds, the deferral, there was a 2-year deferral period for procurement under the new uniform guidance standards. And as of January 1, 2017, so 30-some days ago, 31 days ago, the new procurement standards will go into effect for those December year-end engagements. So for the December 2016 audits, you can still use your old procurement standards, but moving forward, you really need to go back and make sure you've adopted the new standards required under uniform guidance. But even though you're not using the procurement standards under uniform guidance for your current year audit, you still need to use this policies and procedures that you've had in place, and you need to be able to ensure that the organization is following those procurement procedures. And the suspension and debarment, we see a lot of findings associated with this area, and I think it's really important that the organizations understand their policy and make sure that there is documentation of the SAMS check to ensure that the contractor has not been suspended or debarred from working with federal money. Ensure your CFA, or your Schedule of Expenditures of Federal Awards, has all the required elements. Again, uniform guidance, change those elements, and it is management's responsibility. So you want to make sure that you understand all those new requirements. For example of that would, you must have the pass-through identifying number. You must, on that CFA, you also must present the total amount of subrecipient awards that you have given during the year. There are other requirements, so I do say that you should look at that as well. Establish a timeline to ensure proper reporting. Again, if you share that with everyone who is involved with the compliance of the grant, everybody will understand that reporting of when it needs to happen. And again, train staff. You think that your staff understands all the new requirements, that the more training you provide, the better your staff will be able to ensure that they are working within the required standards. So as auditors have to do planning, we do recommend under number 8 that management also has to do their audit planning. And again, this planning is a year-long process for the auditee. So, and what that means is that you should be ensuring that your policies and procedures are being performed throughout the year. Complete those reconciliations. So if there are items noted in the reconciliations, you can make appropriate adjustments and do the proper review to ensure that they've been addressed appropriately. Learn from your prior year audit. The prior year, is always 2020. So talk to your staff about what do you think went right during the last year's audit and what do you think went wrong and how can we do better in those areas. Also have that conversation with your auditors. See what their conversations are and what they can, give you some detail on how the process can improve from the, not only the auditor side, but from the auditee side. Review your prior year financial statements. Go through those financials, look at the disclosures, look at the journal entries that had to be made during the prior year audit, because if you can assure and look to make sure that those particular journal entries are incorporated prior to the start of the engagement, that means that the reconciliation process is complete and the auditor does not have to come in and make those adjustments again, that management has done that. And obviously look at that management letter from prior year, because you want to make sure that management has addressed those comments and, do you have the documentation and do you have the new systems in place that have addressed those concerns. Take a look at that PBC list, which is the provided by client list. Review and assign that list to different staff and give them a timeline of when you expect to have that complete. If there are any questions or comments on the PBC list and or requests that you don't quite understand, please reach back out to the auditor and get further clarification so you make sure that you're getting the right information for the audit. Send your population samples to the auditors early. We like to get it at least 2 weeks early. So for cash receipts and disbursements, we can kind of go through and select our samples and give that to you prior to the start of the engagement so you have time to pull that documentation and have it ready. So in addition to the population samples, we also like to get that trial balance and that CFA, the Schedule of Expenditure of Federal Awards, early as well. So we can do our proper planning and again give you selections for testing prior to the start of the engagement. Perform your own self-review. Make sure that the reconciliations that you are preparing tie to the general ledger. Make sure that the staff that is preparing the information for the auditors, that it's all there and it's complete. So performing your own self-review or your own little mini internal audit will help that process as well. And of course, remember to document, document, and document some more. And this is really during the entire year. And for an example of that is if you get a contribution in the early part of the year and you have questions about whether it's restricted or not restricted or if it's permanently restricted, so call your auditor and really have the discussions there and then document why you selected the revenue recognition that you did and in the period that you selected it in. So have that documentation available. And again, we always like to end with train your staff. You can never have too much training to make sure everyone is all on board with the policies and procedures. So number 9, be prepared. And this is truly one of the most important key to today's conversation. And when we say be prepared, have those key reconciliations ready on the first day of the audit. And it's really typical that when we do start an audit that the significant, like a temporarily restricted roll forward or an investment that is very significant to the organization's financial statements. Those reconciliations are given to the auditor at the end of the week versus at the beginning. If you're able to give those key reconciliations at the beginning, the auditors can focus on the important part of the audit and get that done. And if there are issues or questions that need to be answered, it's done on the front end of the audit instead of the back end of the audit. And due to the timing of when the audit engagement is being performed, if those significant areas are done towards the last part of the audit process in the field, then sometimes it comes back to the office and then there's a lot of back and forth between the auditors and the auditees about finalizing that test work. So again, focus on the key reconciliations first. Always disclose the known issues or fraud timely to the auditors because that will help or it will cause the audit plan to address those issues. Be prepared to discuss analytics in detail, and meaning, at the beginning of the audit, be able to look at your financial information and have the analytic discussion of why things increased from prior year or why things decreased from a budget perspective. Be able to answer those questions because, again, that will kind of also determine how the substantive test will be performed by the auditor. Be able to discuss those prior year management letter comments and be able to give supporting documentation of how you've addressed those comments. Have your samples ready for review on the first day. And that's really important because the teams show up and they are there to start work. So if the samples aren't ready, then they're sitting there trying to find something to do. So the better you can take your samples, cross-reference them to the documentation that that you provide to the sample list or to the PBC list, making sure that what those documentations kind of go back and forth and make sense. The better you can articulate that to the auditors, the less questions they will have for you, and that process will go much smoother. Make sure that supporting documentation is complete and accurate. So an example here would be there was an invoice chosen in a cash disbursement sample, and say this particular check was for $10,000. But that payment was for a contract, and it was just a monthly payment for a contract that gets that has a payment every month. So instead of just pulling that invoice for that particular month, get the actual contract out. Have that as another means to support that particular payment. And then if that particular payment falls up under procurement, make sure you get the procurement documentation so that you can show the support of how the organization satisfied the procurement requirements within their policies and procedures. So the documentation should be full circle, so it should encumber, from the start to the finish of the source document to the general ledger. Update the notes for the financial statements. Go through those prior year disclosures. Look for any new transactions or potential new disclosures and have those conversations very on the front end of the audit. And be available. We certainly realize that as auditees, you have day-to-day operations. However, if you can make the audit a priority and be available to ask questions and pull information and be there as the auditors are having that, the process will go much smoother. And of course, ask questions during the audit process, and even after they leave the field work and it's on the back end side of the audit process. Always ask questions if you're unfamiliar with the process, with where the audit is going, and if you have questions about anything that is internal control related, always make sure you have those discussions with your auditor. And our last 10 key for a successful audit is call your auditor throughout the year. And this, is a very simple thing to do. And really, you want to be able to ask questions when it's relevant. Do not wait until the field work. So if there's a question, an issue, something that you want to discuss, call at the point in time that it's appropriate when it's happening. So your auditor should be available throughout the entire year. And again, communicate any types of issues that come across, any type of fraud, at the point in time that it's happening within the year. Don't wait until the end of or when the field work actually starts. And the other area that we like to say, is to be mindful of as you're going throughout the year is stay up to date on the new FASB regulations. And this should be done not only at the management level, but also at the staff level too. It really is important that you understand the new FASBs that are being presented. Talk to your auditors. They're there to help you and to help educate you. And not all the FASBs will apply. They certainly don't, but you definitely want to make sure that you are fully aware of the significant changes that are on the horizon. So by applying these 10 key areas, you certainly can sit back and relax because your audit will go smoothly, it will be performed timely, and it also can assist in keeping those fees to a minimum because we certainly understand within the nonprofit community the cost of an audit is very significant, and we as auditors want to make sure that you pay the least amount of audit cost associated, and the only way to do that is to make sure that the audit is efficient and effective in order to do that. Because as much as the auditee wants to have a successful audit, your auditor really wants you to have a successful audit. So the two go hand in hand. So these are the 10 key areas that we wanted to bring to your attention this morning. I guess it's still before 12. So we wanted to end the presentation with just talking about a couple of the FASBs that are either being implemented for the December 31st, 2016 audits or that are on the horizon. Again, the ones that we will talk about this morning are not all inclusive. We do encourage you to go onto the FASB website and look at all the FASBs, the accounting standards updates that are issued by FASB to ensure that there's nothing else out there that would impact your financials. But just to give you a couple highlights today, there are two that I'd like to just bring to your attention or to remind you that have to be implemented for December 31st, 2016 audits. And the first one is talking about going concern, the Accounting Standard Update 2014-15. So currently, there is no guidance in the FASB for management's responsibility to evaluate for a going concern issue. This is really done by the auditor. And our evaluation is done for 1 year beyond the date of the financial statement audit. So under this new standards update, and it will be applied to the December year ends, it is now management's responsibility to evaluate whether there are conditions or events considered in the aggregate that raise substantial doubt about an entity's ability to continue as a going concern. And that evaluation is 1 year after the date of the financial statements are issued. So old guidance, we would only have to look at from your year-end date. So if you're a December year-end, say it's 2016, we would have to look at as of December 31st, 2017. However, under this new guidance, if that audit report is not expected to be issued until April, then your 1 year look back or your 1 year look forward is going to be up through the time that the anticipated financial statements will be issued. So if there's a substantial doubt is alleviated, there are some disclosures that you still have to put in the notes, and I've listed them here. You have to look at the principal conditions or events, the management's evaluations, and the plans that alleviate the substantial doubt. And if the substantial doubt is not alleviated, you'll have to disclose in the notes what the substantial doubt is, the conditions and events that raise the substantial doubt, the evaluation of those conditions, and the plans that are intended to mitigate those conditions. The other FASB that will be applied to the upcoming December year ends is the presentation of debt issuance costs. So this is just a presentation issue only, and basically under current GAAP, those debt issuance cost is capitalized and amortized over the life of the debt, and it's included as an other asset on the statement of financial position. So under this new FASB, the debt issuance cost will be reported as a direct deduction from the face amount of the liability. And you can either disclose it on the face of the financial statements or in the notes. The amortization of that debt will be reported as interest expense. And you're going to apply that retrospectively. So now I have a couple of FASBs on the horizon, and I realize that we're kind of at 11:52 here, so I will kind of talk about these very briefly. But before we get into this, the last word of the day for CPE credit is plan. P-L-A-N, plan the audit. Plan. So as we go into what's on the horizon, there's a FASB on inventory, and it's going to be effective for fiscal years beginning after December 15 of 2016. So currently, inventory is measured at the lower of cost or market. And the definition of market, you can look at replacement costs, you can look at the net realizable value, or the net realizable value less some normal profit margin. Under this new standard, the inventory will be measured at the lower of cost and net realizable value, and they give you a definition of what that net realizable value is. This will apply to inventory that's measured under FIFO, the first in, first out, or the average cost, and it does not apply to the LIFO method, which is last in, first out, or the retail inventory method. Lease accounting, we've been talking about this for years. So it's finally, the effective date for the lease accounting is beginning after December the 15th of 2019. So basically, as we've all talked about for years now, the operating leases greater than 1 year will be included on the statement of financial position as a right-of-use asset and a corresponding liability. The finance lease is replacing the terminology of a capital lease, so that hasn't changed that much. You're still going to measure the present value of the lease payment, record it as an asset and liability, recognize the interest separately from the amortization expense, and present it on the cash flow within the financing or the operating, depending on those payments. But the big change is from the operating lease side. You will now have an right-of-use asset and a liability measured at the present value of those lease payments. You're going to recognize a single lease cost that's calculated so the cost of the lease is allocated over the lease term on a straight line basis, and the cash payments will be reported within the operating activities of the cash flow. The lessor accounting is really unchanged. FASB ASU 2016-14, the presentation of financial statements of non-for-profit entities. We've already done a couple of webinars associated with this one specifically in the last part of 2016 last year, but just to highlight for you this morning, this will be effective for fiscal years beginning after December 15, 2017. You can early apply this standard if desired by management. So the big things here are the statement of financial position will show 2 net assets versus the 3 that we do now, with and without restriction. The statement of activities will also show 2 net assets, again, with or without restrictions. You can still use the indirect method for cash flow, so that's always a good point to make. There will be some required enhanced disclosures around board designation, the composition of restricted net assets. There will be quantitative and qualitative disclosures regarding liquidity. They will require classification by natural category to their functions, so that functional expense statement, or you can actually do that in the notes to the financial statement, will be required. You will also have to give additional disclosures around how you allocate cost. Information around underwater endowment funds. And the other one I'd like to point out, in the absence of explicit donor stipulation, the placed in service approach for reporting expirations of restrictions on gifts or cash is also going to be a part of this. The phase 2 part of this particular FASB is still in deliberation, so we'll probably get later this year further clarification on the second part of this particular project. Statement of cash flows, restricted cash. So the effective date here is December 15th for fiscal years beginning after December 15th of 2018. So under current guidance, restricted cash on the cash flow is all over the map. It can be in operating, it could be investing or financing on that particular statement. So this particular FASB specifically states restricted cash should be or will be included in the total of cash and cash equivalent, reconciling the beginning of the period to the end of the period. So there's no more putting it in the other areas within the cash flow. And the revenue with contracts, this has been going on for years, and it has several FASBs and ASUs that have done regards and as a part of this revenue from contracts with customers. The effective date here is fiscal years beginning after December 15th of 2018. And this particular FASB does not apply to any type of contributions, but it may apply to revenue streams from membership, royalty agreements, other areas of revenue that nonprofits have. So there's a 5-step process that you'll have to go through to determine how to recognize revenue. So that concludes the FASB update. Again, we do recommend that you go onto the FASB website to make sure that you've looked at all the FASBs that have been issued and to see if there's any other out there that we did not bring to your attention today. And all the ones that are on the horizon, you can certainly early implement, and that's something you should be talking with to your auditors if you would like to early implement. And before I turn it over to Ricardo, this is our first of a monthly seminar series for 2017, and our next one here is going to be on February 28th, and it's going to focus on the top 10 Form 990 mistakes. So I'm going to turn it back over to Ricardo.
Thank you, Terry, and Trevor for a great presentation today on the keys to a successful audit. So hopefully everybody attending the webinar is going away with a great wealth of information to keep in mind for this upcoming audit within their organizations. Join us again, obviously, on the next webinar coming up for the 2017 webinar series, the Top 10 Form 990 Mistakes, which is going to be held on February 28th, 2017 at 11 a.m. Eastern Standard Time. I'm sure invitations are going out as we speak, so make sure you sign up early. There's going to be a lot of interest on this one. Keep those dates in mind, and hopefully you can open up the calendars. We have our information here listed on the last slide. If there is any questions that we were not able to answer within the webinar, please feel free to reach out to either Terry or Trevor or one of us, and we will make sure that we will get back to you. I'm going to try to squeeze in one question that had just come in, and hopefully one of our presenters will take a shot for it, and we'll just go from there. So one of it is, is using COSO a requirement, and can you give us an example of one of the 17 principles used? Terry?
Sure, Ricardo, I can take that one. COSO is not a requirement, but it does give a great framework for an organization to use to develop their internal controls. So it's not absolutely required. However, the new uniform guidance did make reference that organizations must have written, documented internal controls, and they should, and they use the word should, to look at COSO or Green Book. And the Green Book is really the COSO put in the terminology of a state and local government. So the two documents are very similar. So an example of a principle that would be applied, if you went back to that slide, the control environment has 5 principles attached specifically to control environment. And a couple of those principles would be, does the organization demonstrate a commitment to attract, develop, and retain competent individuals to perform the assigned duties? Another one would be, does the organization hold individuals accountable for their internal control responsibilities in the pursuit of their objectives? And does the organization demonstrate a commitment to integrity and ethical values? So those are some of the type of questions that the principles take a look at and correlate with the different 5 components of internal controls.
Great, great. Thank you, Terry, for answering that question. And due to the lack of time, we're going to take just one more that hopefully Trevor can help us answer. Trevor, this question has come up, so hopefully you can take it. What characteristics should an organization look for when selecting an external auditor?
Okay, it's a couple things that your organization should look at. I think first you should take a look at what exactly your needs are and being honest regarding the current situation. And by that I mean whether or not the organization is actually ready to be audited. As Terry had mentioned, there's several things to take into consideration that would help in the process of being able to be audited. So again, I think one of the first steps is to, excuse me, take a look at what your needs are and being honest regarding whether or not you're ready to be audited. Second thing, I would suggest to ask around, look for references regarding a particular audit firm. Don't just go in the yellow pages per se or Google or on the internet and take a look at and select an auditor based upon, you know, various advertising methods that that organization may use. I think also to take into consideration is do not use fee as the major indicator of quality. That's very key.
And Trevor, if I could just end with that by saying make sure your auditor has the experience and the expertise within the industry and with the type of funding that you receive. So if you do have federal funding, you want to make sure your auditor has a lot of experience auditing single audits under Title II, and you want to make sure that they have the requirements that you need to give you a quality audit.
And lastly, just before Ricardo, one thing just to add to that, as Terry had mentioned, that was a very good point that I failed to mention, but to piggyback on that, definitely make sure that the organization or auditor has enough cover, and by that, enough resources to be able to accommodate your particular needs as it relates to that audit.
Great. Well, thank you, everyone. We're running about 4 or 5 minutes past our time limit here, but as always, feel free to visit our website, follow us on Twitter, follow us on Facebook, and also on LinkedIn, as well as Instagram. We do usually post some great articles and some great state-of-the-art information there, so make sure you follow us. And again, feel free to reach to any one of us if any further questions arise, and we hope to see everyone in the upcoming webinar, Top 10 Form 990 Mistakes, February 28, 2017, 11 a.m. sharp. Thank you, everyone, and hope to see you very soon. Goodbye.